We now want to spend a little time focusing on some of the key initiatives that Altair is undertaking this year. This conference is a great time for us with so many clients and professional colleagues in the room to really share with you some of our thinking about what motivates our decision making and sort of what inspires us to do different things at Altair. And there's really no better person to talk with you about that than Jason Laurie, who's one of our founders, a managing director, and the head of Altair's investment committee. So with that said, Jason, I'm going to ask you to come to the stage.
Thanks, Anna. Here it is. As Anna and Richard said at the beginning, I'm really today going to outline our totally new approach to how we're investing in small and micro-cap stocks. And really today I want to walk you through how it is we arrived at that decision and then spend a little time on the investment itself. So let's start with backing up and defining some of the terms that we're talking about and looking at the overall U.S. equity publicly traded stocks. So on the left-hand side, these are all the publicly traded stocks that are in the Wilshire 5000, the broadest index that we have in the U.S. Now you're probably first thinking, well, that's not 5,000. That's correct. It's not 5,000. There isn't 5,000 stocks in the Wilshire 5000. That number has dramatically changed over the years. And that's one of the issues that we're going to talk about, is that the number of publicly traded stocks in the U.S. has dramatically fallen. A little known fact, if we were at this conference about 12 years ago, that would be double. This number would not be 3,800. It would be more like pushing 7,000. So the amount of publicly traded stocks is far less today than it was in its merger and acquisitions, its companies not coming public. There's a whole host of reasons as to why there are less public companies today than there were even 10, 12 years ago. So we break it out into three categories. I broke it out into three categories. These are using Russell's definitions now between the market cap. 200 is really the largest companies in the U.S. About 1,800, I'm saying, are small and mid-cap. Again, the definitions change depending on who's you read. And then finally, we have this whole blue category, which we're going to spend a lot of time on today, is micro-cap stocks. So this is the number of publicly traded companies. Now let's look at the value, the market capitalization. So market capitalization is nothing more than the number of outstanding shares times the price, or it's really the stock market's value or net worth of any one company. So again, we take these almost 3,800 companies, and that total value of U.S. publicly traded stocks, large cap all the way through micro, is 24 trillion with a T. And of course, the first observation you make is that the top 200 basically account for 2/3 the value. And that makes sense. Apple's the largest stock today, and it's $650 billion is the market capitalization, the net worth. It's just a ginormous company. But we have all these other classes. And I put a little example. This is a Chicago company, Inner Workings. They're here on Chicago Avenue, and they help companies with their marketing. But it's a $500 million company, a micro-cap company, which would not be traditionally small or traditionally, of course, large. And so we've got 1,800 stocks that only count for 2% of the value. So to say that this isn't on anybody's radar screen is an understatement. It just represents virtually no value when you look at the whole 24 billion market capitalization of the publicly traded stocks in the U.S. Okay, so now that we have the definitions around large, small, and microcap, let's look at some performance. This is, of course, why we're all here, is performance. And let's start with going all the way back to 1926. 1926 is the generally accepted number for the start date of good data. It was produced by the CRISP database. This is a University of Chicago database. And they started this in 1926. And they broke it down by deciles: large cap, mid cap, small, and micro. So you can see this whole period, 1926 to 2014, that the average return in this roughly 88-year period of all these classes. And of course, what jumps out to you is that microcap actually outperforms all of them. Large cap's not bad at 10%, but microcap actually outperforms all of them. And so the idea here is that these little guys here, they may be small, they may not represent a ton of the market capitalization of the stock, of the U.S. stock market, but they certainly pack a pretty good performance punch in their long-term record. And then over here, we're tracking not the annualized rate of return, but the growth of $100. And I always find these so fascinating, that if for 88 years, if you invested $100 in large, mid, small, here's your ending net worth. And of course, it's amazing how compound interest works. I think it was Einstein that said it was the greatest mathematical discovery ever, compound interest. And look how 1.8% differential in the annualized return for an 88-year period, it equates to 4.5 times more ending net wealth. So small changes in the annualized rate of return equals a huge difference in ending net wealth. So this was the 88-year period we look at. Now let's look for consistency. And I think this is an important part, because sometimes when we have long time series of data, what we're missing are there are a few key years that skew the whole annualized rate of return. But if you look at what we've got here, we're starting with 1926, and we're looking at, instead of the entire annualized period, we're looking at 10-year rolling returns. So we're looking at all these 10-year rolling returns, starting in 1926, going all the way through 2013. And again, the blue shaded is where microcap outperform the large cap. And you can see it's fairly consistent. It's not just that microcap had one period that did really well that's skewing the whole data. Now, what you will notice, though, is we did have a sustained period, really starting in the 80s through the 90s, where large cap did outperform microcap. But if you look at the entire data set, it's a pretty consistent story that microcap outperforms. And in fact, the specific number is 72% of these rolling 10-year periods outperform. Some other very interesting characteristics when we started to look at this asset class, and we really started in the small cap arena, and it led us to microcap. We didn't even necessarily start in microcap, we just started with small and wanted to see if there was any other observations we could make. So the first is the percentage of insider ownership. And microcap companies have the highest insider ownership by company management versus the other categories. Here I'm showing it against small cap. So 16% of the outstanding value of microcap companies are owned by the insiders. And so the implication is that as a shareholder, your interests are more aligned with management because they own more of the stock. And so they're clearly motivated to move the stock price. Another very interesting, and these two bottom ones kind of really go together, is microcap stocks don't have as many analysts following them. One of the reasons is they're smaller. If you're talking about a company with only a $500 to $750 million market cap, there's less analysts that are interested. So there's a whole 14% of the microcap universe that don't even have an analyst. And we didn't show you all the rest of the data, but if I would delineate it by one analyst, two analysts, three analysts, the data is even actually more compelling in the sense that there's very few analysts that as a group are following microcap stocks. Again, we think that's a good thing, because if you're investing money in a manager who's doing their homework, they can certainly have an informational advantage over Wall Street, who's not really following it. And then we get to the institutional ownership. The bottom line is some of the largest pots of money that go into the U.S. investment markets are not in microcap, because it's the reverse problem that most individual investors have, which is they actually have too much money. And to put that much money to work in the microcap space is very, very difficult, because you wind up owning too many shares of the outstanding company. And so that's why they always direct their capital more to the large and the mid cap. So again, underfollowed, not on as many radar screens. So let's take a look at the composition of the two indices. This is microcap and this is the small cap. And really what you can kind of gather at a quick glance is that the sector compositions are actually not that different. They're pretty similar. So when you move from small to micro or micro to small, you're not really taking huge sector bets per se. It's more about the size of the company underneath. Instead of being an average market cap of 1.4-ish billion, you're down to about $500 million, or $500 million with 500 million. The only really one, if you kind of look at it closely, is healthcare. There's consistently a higher allocation to healthcare in the microcap space than there is in the traditional small cap space. That's really the only consistent weighting differential. Well, when we first started digging into small cap and in particular microcap, the first conclusion that we immediately came to was, well, gee, microcap sounds more risky than than a traditional small cap portfolio. Well, when we started to look at the data, that just really wasn't actually the case. And so if you take standard deviation, which is a measure of volatility, the higher the standard deviation, the more risky the stock or asset class, the lower the standard deviation, the more conservative, the less risky it is. And if you plot microcap standard deviation right on top or on the same chart of small cap, what you can really see is the two lines basically fall right on top of each other, meaning there's really no material difference between a small cap and a micro cap indice in their overall riskiness. They're virtually the same, even though it's smaller companies. Now, what we're not saying today is there's a free lunch, because there's not a free lunch. Small cap and micro cap stocks are in fact more risky. The line I just put in here is the S&P 500. So they are more risky, they're more volatile than large cap stocks, but the takeaway point is that moving from small to micro does not meaningfully increase or decrease risk. It's virtually the same. Another way to look at risk is through beta, which is just measuring how risky the stock or asset class is vis-a-vis the market overall. Again, the higher the beta, the more risky, the lower the beta, the less risky. And once again, we plot micro cap and we plot small cap on the same chart. The lines are basically right on top of each other. There's no material difference in risk, whether you measure it by beta or standard deviation of either of the asset classes. So right now the story is building that we have a higher expected return, at least historically, for virtually the same level of risk. Another attractive component that we think about microcap, and this is also true of small cap though too, is that if you look at the mergers and acquisition activity, and one of our managers, Driehaus, a local manager here in Chicago, did some work on this. And they looked at the number of transactions from 2003 to 2014. And it turns out that 67% were microcap stocks. So these stocks are being taken out, being bought out at a far higher premium than large cap or small cap or medium cap, mid cap stocks. And now this is number of transactions. So now I'm talking size. This chart would be totally flipped if we were talking about size of transaction, because large cap stocks, the transaction size is much, much bigger. But we're talking about the number of stocks. And again, as a holder of microcap stocks, typically we want to be a holder if our stock is going to be taken out at a premium. And that's one of the things that I'm pointing to Paul in our research group that we initially first started to recognize when you start talking to microcap managers. They all start the call the same. Well, this quarter we had so-and-so and so-and-so taken out. That's how they start the call. It was really the only asset class when we started following that that's how they start the call. These are the handful of stocks that got taken out this quarter. Now, one of the initial questions we had is, well, geez, do you even really want to play around with microcap? Is microcap even really worth it? And the answer is yes to us. And one of the reasons is if you look back just in the 12 years since we started Altair, Altair as of 2002 was our beginning, look at the difference in the average market cap of small cap. So in 2002, the Russell 2000, which is small cap, started at about 700 million, which is pretty much the definition of microcap today. But that same small cap index is basically double today. The average size of the company is double. So in some ways, internally, we say micro is actually the new small. And that if you're interested in buying $500 to $700 million publicly traded companies, you're not going to find it in small cap anymore. You have to move to microcap because that's where they are today. So I showed some performance on the rolling returns of large and all the other asset classes. Now I'm isolating just small versus micro. And again, the same conclusion emerges. This time we're looking at more recent data and looking at 3-year returns. Again, 3-year returns, 67% of the time microcap outperforms small cap. And again, in the slides before, we're not doing this with any more risk. Okay, so I covered most of the asset class, the big picture categories. And as you know, Altair does a lot of work on the difference between an indice, a time series of data that you can invest in, and actually investments that you can invest in. So now we're switching gears into, okay, how do we actually make the investments? Where should we make the investments for the category? And so what we've done here is we've taken all the active managers, both in the mutual fund space and the separate account manager space. So now I'm in microcap now. I'm just isolating microcap mutual funds and isolating microcap separate accounts. And I'm saying, what is the excess return? Excess return can be positive or negative, as you see from the screen. But what is the excess return of the average managers in either one of those categories? So are they beating the investable benchmark? And so first conclusion you can make is if you look at the 10-year excess return, and again, these aren't the total return, these are just excess above and beyond the benchmark, is that both the mutual funds and the separate accounts are in fact beating these indices over long periods of time. But if you look at the stream from 1, 3, 5, 7, and 10 year, the picture emerges pretty clearly where you want to be. That if you're looking for excess return, if you're looking for the best managers, you really have to be in the separate account manager space. The mutual fund space, and we've looked behind the curtain of some of these figures, the mutual fund space in the microcap area is really no other way to put it but just blah. The candidates are just not very good. And not to mention their fees are higher. So you really want to be in the separate account manager space. Now, in a moment, I'll tell you there's a bit of a problem with that, but we'll get to that in a second. So now that we've identified that we really need to be playing in the separate account manager space, let's take a closer look at the data within the separate account manager space. And if there was any slide that I showed you today, this is by far the slide that really initiated us to take action. And that's because when we looked underneath the hood of all the separate account managers in the micro and small cap space, and we looked at top managers, average managers, and even bottom managers. So we break up the category into 4 components, and these are top, these are bottom, these are the middle. And what emerges is that the separate account managers in the microcap space, forget about the top managers, even the average managers and the bottom managers do extremely well. And so we immediately concluded we have to figure out a way to get access to these top managers, because we don't like to go into an asset category if the only margin for error is we have to only find the top manager, because that's a hard game if you're only going into it because you can find the top manager always. But the margin for error here is pretty big, because even the bottom managers do fantastic vis-a-vis the other categories. So that was really the eye-opening slide to us, is that we really want to get access to these managers. The major problem with these managers, the separate account managers in the microcap space, is they're very picky. They do not want small accounts. They do not want break up their investments into small individual accounts. They have high minimums. They only accept a small amount of investors. And the reason is that they can only take really about a couple $100 million to invest. And so you all, and I know there's a whole group in here that run their own businesses, if your customer base, if you can make the same amount of money and have a much smaller organization and have to touch and deal with a lot less people, you do it. And that's just the decision that these guys are making. If they're really good at this, they don't want 2,000 accounts, they want 50 accounts, or whatever the number breaks out to be. So the challenge here is we have to get access to these managers, but the problem is that they really only take single large accounts. And that was really our dilemma. And so if you kind of look through the summation of the data that I presented, here's kind of where we came out, which is we want to enhance our current small cap offerings by including microcap. We think that's really important. And it's not just the category, it's not just the asset class, but it's also, bullet point 2, getting access to these top managers. There is a lot of excess return that is available if, in fact, you can avoid the mutual fund space and get to the lower fee top separate account managers. Another very interesting, which is really a corollary to the managers are picky, is that you have to secure capacity with these managers early on. Once they have a fantastic track record, they're not interested in taking new money. They already have an established client base. If they want more money, they'll go knock on the door and raise it from existing folks. They're not really interested in establishing new relationships. So they close. So you got to secure capacity before they close. Of course, we're always looking to drive down investment fees. Another thing that we didn't like about the mutual funds, the average fee of mutual funds in the microcap space is way too high. The hurdle's too high. And then we want to incorporate Altair's manager performance cycle research. And for those that were at our forum last year at this same time, we really unveiled our research on manager performance cycle. And the bottom line punchline to that research was there are opportune times to allocate money to managers, and there's opportune times to take money away from managers. And you need the flexibility to be able to do that, because it can really enhance return. And of course, what the majority of investors do is they plow money in just after a manager has had a fantastic run. And of course, we know how that movie ends. And so you want to try to get it in before. And that's really the crux of our research. And for those that have not read that white paper, that's available if you'd like to read it. So this sums up to how did we solve this problem. As many of you know, as Anna and Richard talked about at the beginning, is that we've created a fund exclusively for our clients. And the primary reason for this fund is so that we could access these top managers that were sitting on this page, but yet we could never really access without this pooled group of capital. And so in our mind, this fund maximizes all of our clients' buying power to be able to access these managers. And it's really this ability to get the managers that we want. It was the main driver behind the fund. So taking a minute on a little more of the mechanics of the fund. First of all, Altair is not charging any additional fees for the fund. The fees that we charge our clients don't change. The fees of the fund are those that we've negotiated with each of the underlying managers, the pass-through to the managers, and there is an administrative and compliance fee for keeping the structure up and running, which is outlined, as some of you may already have on your table in the prospectus. But all in, we want the fee to the fund to be the same as approaching one of these separate account managers as it would be within the fund, and much lower than the mutual funds in the space. This is a liquid fund. You can buy and sell it every day. There's no commission, there's no load, etc. We launched the fund last month, and we're just at the beginning phases of getting client money into it. As we sit here today, there's just shy $100 million in the fund. So each of these managers have roughly a little over 15, 16 million in their individual pots. And so we are excited that this is really taking our investment approach in this category to what we think is the next level. And so before I take a few questions, I'm going to make my compliance people in the room happy and tell you that, of course, before investing in any fund, you have to read the prospectus. It's available outside, out on the table, and you can see that you can request the